The 1920s in America were a time of unprecedented prosperity and optimism. The First World War was over, and the United States emerged as a global economic powerhouse. New technologies like the automobile, the radio and the telephone were rapidly changing lives. Wall Street pulsed with frenetic energy as millions poured their savings into the stock market. The Dow Jones Industrial Average climbed steadily, fueling a sense of euphoria. Jazz music filled the airwaves and flapper dresses challenged traditional norms. However, beneath this prosperity, risky financial practices were brewing, setting the stage for a catastrophic collapse. The seeds of the 1929 stock market crash were sown in the exuberance of the Roaring Twenties. The stock market boom of the 1920s was driven by speculation. Investors poured money into stocks not based on value, but on the expectation of rising prices. This speculative frenzy created a dangerous bubble, inflating stock prices far beyond their worth. Buying on margin allowed investors to purchase stocks with borrowed money, amplifying both profits and losses. The lack of regulation in financial markets allowed risky lending practices to flourish. The government took a hands-off approach, letting banks and brokers engage in speculative activities. This toxic mix of speculation, easy credit and lax regulation created an environment ripe for disaster. The stock market became a giant casino driven by greed and herd mentality. The Roaring Twenties saw the rise of legendary financiers, synonymous with the era's opulence and recklessness. Charles Mitchell, president of National City Bank, aggressively promoted margin buying, exposing ordinary Americans to greater risk. Irving Fisher, a renowned economist, famously proclaimed that stock prices had reached a permanently high plateau just weeks before the crash. These men, along with other Wall Street tycoons, played a significant role in creating the conditions that led to the crash. Their pursuit of profit, often at the expense of prudence, contributed to the culture of speculation and risk-taking. October 24, 1929, known as Black Thursday, marked the beginning of the end for the bull market. A wave of panic selling swept through the New York Stock Exchange as investors rushed to unload their holdings. The ticker tape fell hopelessly behind, unable to process the sheer volume of sell orders. The Dow Jones Industrial Average plummeted, wiping out billions of dollars in paper wealth. Desperate attempts by bankers to stabilize the market proved only temporarily successful. The selling resumed the following week, culminating in Black Tuesday, October 29th, with an even more devastating decline. The crash of 1929 wasn't just a financial crisis, it was a national trauma. The American public watched in disbelief as their savings were wiped out and their dreams shattered. The stock market crash of 1929 sent shockwaves throughout the American economy, ushering in the Great Depression. The collapse wiped out billions in wealth, leading to a sharp decline in consumer spending and investment. Banks, heavily invested in the market, began to fail at an alarming rate. Businesses, starved for credit and facing plummeting demand, laid off workers, leading to mass unemployment. By 1933, the unemployment rate soared to 25%, leaving millions jobless and desperate. The Great Depression wasn't just an economic catastrophe, it was a profound social and psychological crisis. Farmers faced ruin as the Dust Bowl devastated the Midwest. The once vibrant cities, now filled with soup kitchens and homeless encampments, became grim reminders of the nation's economic paralysis. The 1929 stock market crash and the Great Depression forced a reassessment of the nation's economic system. The crash exposed the dangers of unbridled speculation and lax regulation. In response, President Franklin Delano Roosevelt implemented the New Deal, a series of programs and reforms. Key reforms included the creation of the SEC to regulate the stock market and the FDIC to ensure bank deposits. The legacy of the 1929 crash continues to shape American economic policy. The lessons learned serve as a reminder of the importance of financial regulation and the dangers of unchecked speculation.